I wonder how many of our viewers thought we'd be looking at a weakening Aussie dollar in the last half of the year. Well, my guest tonight will help unpack what's driving currency markets at the moment. Boris Schlossberg is the Director of Currency Research at GFT, providing online currency trading services. His career on Wall Street began over 20 years ago with Drexel Burnham Lambert, where he traded everything from equities and options to stock index futures and, of course, FX. And Boris Schlossberg joins me now. Boris, welcome to the programme.
Hi, it's great to be with you. Great to be down under.
OK, well, this Aussie dollar down under first. A lot of confusion that the A dollar was going up against the US dollar because we were riding high on commodities. Right. So now what is happening? What's driving the weakening?
A couple of things. Number one, Aussie dollar is very, very tied to what's called risk appetite. That means when global equity markets rise, the Aussie dollar tends to rise with them. And when global equity markets retreat, as we've seen all across the world, it just showed that all of the markets were down very large. The Aussie dollar tends to be very highly correlated to that, and so it comes down naturally because of that. And secondly, the market is starting to get very, very concerned about what's going on in China. And of course, Australia, in America, we almost kid around that Australia has become a wholly owned subsidiary of China at this point. A couple of things that I saw that was kind of very interesting was that the RBA has now opened an office in China, that the Australian farmers are all cycling themselves to the Chinese cycle as far as food prices go. So there's an incredible intricacy between the two countries now. And the fear that the Chinese are actually going to be going for a hard landing is having a very negative impact on the Aussie as well.
This story has been creeping up on us because at the beginning of the year it was almost like, no, it can happen. It couldn't happen. I mean, China is the country that's going to pull everybody along.
It was the locomotive of the world. And now we're starting to see some slowdown. And there's also fear now that the debt crisis that we're seeing in Europe and the U.S. may also be hitting China. There's a tremendous amount of debt overhang they're afraid that may not be of very high quality.
You've got this great idea that sort of the whole world is turning into a Japan. Can you explain that?
Yes, I call it the Japanization of the world. And I think what's really happening is what you're seeing is massive amount of huge debt overhang across Europe, U.S., perhaps even China at this point. And governments basically fighting it by trying to spend their way out of the problem. And we saw what's happened in Japan when they've done this. The net effect is that the economy just tends to muddle on through for years and years and years because you're not retiring the debt, but at the same time, you're not really putting yourself into a recession because the government constantly tries to stimulate the economy. And we may be in for this very long period of low growth all across the world until we figure out what we can do about all of these debt overhangs that we have.
While we're figuring it out, we've got the Euro inspectors in Greece saying it can't meet its financial deficit targets this year or indeed next.
Right.
We've got this Project Eureka, Angela Merkel's secret plan to save Greece, which I understand is sort of lumping all the Greek assets together, the public assets together, and getting some sort of European institution to buy them and then privatizing them by some point out to 2025. Is that going to help?
That will help if they can actually do it. Economically, it makes a lot of sense because the idea here is to take Greek private assets and then retire almost 50% of Greek debt, automatically minimizing their debt service costs overnight. And then at the same time also investing about 50 billion euros into Greece in order to stimulate growth. So overall, that seems to make a lot of sense economically. The critical thing is, can they do this politically? Because this really requires the agreement of all the European member nations to do this. And there's a huge amount of resentment now against Greece, and I think that's going to be the very hard part to get it going.
Meanwhile, on the US side, we've got non-farm payroll figures coming out this week. That's employment, very important, coming out on Friday. What do you make of the euro versus the US dollar? What's the outlook there?
Well, actually, if we get good non-farm payroll reports, that actually should be positive for Europe because that's really positive for risk appetite and a little bit negative for the dollar. The dollar tends to really rally when the news in the U.S. is kind of bad as a safe haven harbor. We probably may have a little bit of ray of sunshine here this month because Verizon workers are coming back online. It was a big U.S. telecom that was on strike last month. So we could have a relatively good number. That should be maybe positive for risk, positive for the euros into the end of the week.
So in your view, where's the best place for investors to put their money at the moment?
Well, it's very difficult to find any place that's kind of a safe haven harbor at this point. I still think that precious metals are probably a great buy on any kind of a dip, simply because the fiat currencies all over the world are in structural trouble. But honestly, I would say to me, from a currency point of view, there isn't anything that I love, but I will say that I think the Great British Pound is something that I truly hate at this point as a trade. I think that that's something that could be a huge short, because the UK economy is much worse than the market thinks, and I think the BOE is actually going to do another round of quantitative easing, which would be negative for the pound.
Even though they're very rude about Europe. Now, let me ask you finally about high-frequency trading.
Yeah.
What is it, and should we be worried about it in the FX market?
Yes, I think it's a serious concern. It's not something that a lot of people know about. But for example, what people don't understand is that fully 1/4 of the $4 trillion a day that gets traded in the currency market is now done by machines. And machines can execute trades at 1 millisecond per trade, which, to give you an idea of how fast that is, we blink at 150 milliseconds. So that means in 150, they can do it faster than our blink at 150 times.
So the computers are competing against ordinary human beings?
They've won the race. It's impossible. If they can do it at 150 times faster than a human blink. So a human trader could never beat a computer to a trade. The big problem is when you have a massive move in the market and all the computers basically move together, they could essentially pull all of their liquidity out of the market, and you've seen these kind of flash crashes. We've seen them in the stock market in 2010. We've seen it in the yen in 2011. When these events occur, you basically have a vertical move to the downside, and if you are highly levered in the FX market, which a lot of people are, then you have tremendous amount of risk, because you basically get blown out of the market through no fault of your own, and there is no recourse in the FX market. Nobody's going to correct your trade like they do in listed equities. So it's very important to stay secure, and also not to over-lever yourself in the FX market because of these conditions that we live in.
Don't get exposed in that way.
Right. If you're going to trade on low leverage, because high leverage with this kind of a combination of high-frequency trading could be very dangerous going forward.
So it's a very scary development in these volatile markets. Boris Schlossberg, thank you very much for joining us.
Great to be with you.